While we're waiting for that, we're just going to quickly introduce ourselves. So, hi everyone, I am Ravija, and I am currently one of the portfolio managers and also serve as the chair of the Redhawk Fund. Um, and I am part of the Masters of Science in Finance program at Albers. Kathy?
Thank you, Ravija. Hi, everyone. Thank you for coming. I'm Cassie Cao, a finance faculty member. I mainly teach investments, derivatives, and fintech. And I've been advising the Redhawk Fund since 2012. So it's been a long time. I enjoy doing this, working with students. So, Elias?
Thank you, Kathy. Yeah, hi guys, I'm Elias. I'm an undergrad in my third year studying accounting, business analytics, and finance, and I'm also a portfolio manager along with Rong and Yichen and Ravija, who is our chair. Rong, you want to go next?
Thank you, Elias. Hi, everybody. I'm Rong. I'm a student. I'm also a portfolio manager for the Redhawk Fund since last December. So I have been enjoying the equity valuation ever since, and enjoy the community of the Redhawk Fund. Welcome. How about Yichen? Are you ready?
Hi, my name is Yichen. I'm also one of the portfolio manager at Redhawk Fund. I've been enjoying Redhawk Fund since January, and also in the MS program, which I will be graduate next quarter.
Thanks, Yichen. I love that we're all saying we've been enjoying the Redhawk Fund for so and so time. All right, that's wonderful. So we've got lots of stuff to cover today, so we're gonna go ahead and get started without much ado. There are still a few people joining us, so we're just gonna let them join us when they're ready. And yeah, welcome to our third ever investment series this quarter. Also, it's fully virtual, probably gonna be the same way next quarter, so maybe we'll see some of you again on Zoom. And today we're gonna do things in three different parts. The first part, all the portfolio managers who just introduced themselves, we are going to kind of give you an overview of what our fund looks like, what we do, why we do it, and some of our operations, and just some insights into the next year that we have planned. The next part, we will be playing a fun trivia game, which does have some prizes involved. So please pay attention to our presentation, because some of the questions which are specifically related to the Redhawk Fund, you might find answers in our presentation. And then the last part, we will have two of our analysts, Chris and Keisha. They will tell you about their valuation on one of the financial sector companies. All right, so getting started. In this first part, we are basically going to talk about our overview, and then we spend the summer thinking about what the future will bring, especially in consideration of our investment horizon and our investment strategy. So we conducted domestic and international market analysis. We also looked at different sectors. All of our analysts participated in that. And we did an analysis of which sectors we should invest in for this future year. And we concluded everything in an asset allocation summary that we will share with you. In terms of fund overview, the Redhawk Fund was started in October 2009 with $250,000 from Seattle University's endowment. It is only a small part of the university's endowment, and it is a completely student-managed, actively managed investment fund. We, according to our IPS, our investment policy statement, we invest in US large cap equities only, with the exception of utilities and energy ever since we went fossil fuel free. So our benchmark index is the S&P 500 fossil free index. So our main goal of the fund, our mission, is to provide a professional learning opportunity for our students, while at the same time maintaining performance at par or above the S&P 500 fossil free index. So that is how our advisory board judges us, is whether we out or underperform the index. We currently have a team of 20 students, 4 portfolio managers and 16 analysts, and we are recruiting. So if any of you all are students at Seattle U and are interested, our application deadline is actually tomorrow. So You should have received an email, but if you would like more info, we'd be happy to talk to you about that as well. We are advised by Kathy, who is here. She is our faculty advisor. We have a student advisory board comprising of past chairs, and we also have the Seattle U's Finance Department Advisory Board, which is comprised of industry experts and people from the university who advise us on our operations. So in terms of how we do things, our focus is on top-down analysis. So fundamental, we always go back to fundamentals, qualitative and quantitative factors. And our emphasis is on long-term sustainable growth. At our valuation level, we use intrinsic valuation and relative valuation as required by our IPS, and we use models such as the discounted cash flow model and market multiple models to come up with target prices. So basically, it's a three-part process. First is, you set an allocation for, usually it would mean different assets, but since we only invest in large cap equity, we allocate our portfolio between different sectors. And then at the security selection level, our analysts will go in and look at all these factors, macroeconomic factors, industry competition, and so on, financial strength, and select equities and perform valuation on those equities, and then evaluation. So every year at the end, we will go and look at our portfolio and see how we did compared to our benchmark. This is currently what our portfolio is comprised of. As you can see, we have a large cash holding right now, about 12%. We brought it down from about 25% in May, and that is one of the main reasons we were able to survive the pandemic shock so well. That was in early March, and we recovered well. We, as you can see, year to date, as of last week, our fund is up 12.82% versus the S&P 500 fossil free total returns index, which is up 7.91%. So as compared to our benchmark, we are doing quite well. And these are the 8 sectors that we invest in. And these are their relative weights currently in our portfolio. This is a list of all of our holdings. This data is also as of last week. As you can see, we hold 28 stocks across 8 sectors, and our cash holding, like I said, has gone down quite a bit, and we will target a 4.5% cash for this coming year. As you can see, some stocks we hold more than others. For example, Apple is our largest stock holding. So we are also trying to diversify away from, it's just because we've been holding it for so long, it appreciated so much in value. That's become a big part of our portfolio. And we're trying to diversify away from some of these large holdings. And this is just year-to-date performance. As you can see against our benchmark, this top white line is our fund. The bottom line is our benchmark, and we have been outperforming consistently.
All right, so in terms of the operations aspect, before we recruited our new group of analysts, we developed a series of videos covering the valuation process and best practices. And this served as a step-by-step guide for analysts to help answer some of those simpler questions that we as managers get and save time for the more critical questions that come up. So this picture right here is some of the videos that we've uploaded so far. And since we have a bigger team this quarter, we've also shifted to pairing up analysts for valuations. So that's why both Chris and Keisha will be presenting one company today. And this was because we had to figure out a way to fit everyone into the schedule we had planned. With this adjustment, though, we also made it clear that our expectations are much higher for the presentations and valuations in terms of the depth of analysis. With everything shifted to an online atmosphere, we also brainstormed ways that we can elevate the interactivity among analysts. So we have 15-minute breakout groups at the beginning of each meeting for analysts to discuss market news and get to know each other. And we've also implemented a stock trading game this quarter through MarketWatch.
All right, next we're going to go into our outlook for the next year.
Yes. So as Ravija mentioned before, we did a sector analysis this summer, and because we are doing top-down approach, so we also did the domestic outlook and the international outlook. So for the domestic outlook, we first look at the manufacturing index. That's a measure of manufacturing activities based on a monthly survey. So from the chart of the right side, you can see, although the monthly PMI index dropped dramatically in April, yeah, it has been picking up quickly and staying above 50% since July. So at the 50% is seen as a positive territory for future growth. We expect a steady recovery. So next page. For the durable goods orders, we also seen an increase for 4 consecutive months since May. That also suggests an expansion in production and the new orders. Next page. For the consumer confidence index also has improved in September. It reflects a favorable view from the customers for the short-term income and business conditions. So next page, we can see the Fed's report in September. It expected next year will have a rebound at a 4% growth rate and gradually slow down to 1.9% for long run. So that will all factor in our equity valuation and also did into the sector analysis. For the risk part, mostly we include the drop of tax, deficit, supply chain interruption, and the COVID uncertainties. As we know, the tax collection has dropped because of the Tax Cuts and Jobs Act, and the federal spending has been rising, which outpaced the tax collection. The government spending, we are expected to become slowed down. Actually, the 2020 deficit is expected to be 3.3 trillion. I think today's news reported 3.1 trillion already. So 3.3 trillion is at 16% of the GDP. That's the largest US deficit since 1945. So that could negatively affect the economy's sustainability. Also, the dollar value is vulnerable to a decline. Supply chain interaction also remains because of geopolitical tension and the potential export restrictions. Also, some restrictions found for the freight. We also acknowledge the vaccine availability and the presidential election still remain uncertain. That puts a question about the sustainability and resilience when we are valuing equity. Yeah.
All right, thanks, Rong. So as you can tell, there's so many different factors we have to take into account when doing our equity valuation, because everything happening around the country can affect it, and then also just because our companies are not just geographically isolated, although the companies that we invest in are based out of the US, they have dealings all over the world, they have customers around the world, they have trade deals with other countries, and they're affected by all those things as well. So we also look at the international outlook for the next year. And as you can imagine, the pandemic has rocked not just the US economy, but globally everywhere around the world. So the IMF revised their global GDP forecast to be even more negative, to negative 4.9%. This is down from their 3% forecast a few months ago. And most economies are expected to end this year, 2020, on a negative GDP note, except for China, because the virus was caught there early, restrictions were placed early, and so China is on the path to a good recovery and positive GDP growth this year as well. So these effects will go into next year and beyond as well, which is what we have to take into account when we make our investment decisions. Unemployment rates, it is estimated that 80% of global jobs have been affected, and so unemployment rates are coming down already, but the expectation is that we expect that some jobs will be lost permanently, so that will take a longer time to recover. And supply chains have also been disrupted, and lots of economies, like Rong said, the US and others have taken on more debt to make changes in their monetary and fiscal policy to support their economies. So, as you can see, this chart here shows change in retail sales. Like there was a big drop in April, but then in June and July, it says, it shows that this is recovering, and this is in many different countries across the world. But there are some retail industries that have been more affected than others. For example, anything involving people being in close proximity with each other because of social distancing rules, those can't happen. So, entertainment, travel, performing arts, hotels, and so on. So, we expect that this will continue at least through the first half of 2021. So, we kind of have to be prepared for that. And if we're looking at investments, we're seeing that these are, these industries are currently discounted. We'll talk more about that when we get to the consumer sectors. But we believe that demand will be affected through the next year and beyond as well, because if it's an uncertain economy and people still have, their don't have their jobs back, people are more likely to save money than spend it. Outside of China, rebound in industrial production will also be slower, as everything starts back up. And there are concerns about second and third waves of infections as well. So before a vaccine is completely developed and available for widespread use, those concerns will continue to affect how these companies work. And US and India, there are some economies in Europe and in Asia that have done a remarkable job of recovering from the pandemic already. But US and India continue to have, daily new infection numbers in the 50 to 60,000 range. So these economies will take a longer time to recover. Right. So basically, it's just, there's so much uncertainty about the future. Like Rong said, vaccine development will be a big instrumental factor. And global trade will definitely suffer, at least in the next couple of years. And one big thing is also, as Rong also mentioned, like the election coming up, trade tensions, the US-China trade war, how things are changed when a new government comes into place. All right, we're going to go into our sector analysis right now.
All right, so for the IT sector, we're currently holding Adobe, Apple, Citrix Systems, Intel, and Microsoft. Our current weight in our portfolio is 26.7%, and our target weight is 25%. And this target has been in our IPS to reduce concentration risk. The IT sector is a very high growth sector and has been outperforming the market since the pandemic due to remote working and how much we use technology now in our everyday lives. There are still a lot of growth opportunities between the cloud computing and cybersecurity sub-industries, but as of right now and for the foreseeable future, this sector is very overvalued. We're seeing a lot of volatility in this sector, mostly driven by crowd behavior and the anticipation of all IT companies beating earnings expectations. With the CAPE ratio, also known as the cyclically adjusted price to earnings ratio, consistently growing in the past 5 years, it's safe to say that we won't be finding a lot of bargains or discounted stocks in this sector until we see some sort of correction or drawback. With remote working at an all-time high, IT has been focused on making productivity solutions for people and companies based on subscription-based revenue like Adobe, and those companies have been doing exceptionally well with low rates of cancellations. And in terms of the impact of COVID-19, we see negative impacts from companies making physical goods. So for companies like Apple and Microsoft with their raw material supply, the electronics value chain in general, these are things that are going to be negatively impacted for the foreseeable future. And for the financial sector here, we're currently holding Berkshire Hathaway Class B stock and CME Group. Our current portfolio weight is 4.72%, and we're hoping to decrease this to 4% for our target allocation. Since the pandemic, the financial sector has been underperforming relative to the S&P, and this is mainly due to the negative outlook on banks and the low interest rates. Fintech companies like PayPal and Square have been soaring with online shopping at an all-time high, and common investors have been pushing the stock price to a point where they're overvalued. Both stocks have over doubled in price since the pandemic began. This chart shows the transaction value in the fintech market forecasted to 2024 from 2017. So we can see this constant growth, especially in the digital payments and personal finance. With all this anticipation, it's difficult to find a fintech company that can be a good addition to our fund with a lot of room for growth. On the other hand, banks are heavily discounted as of right now due to the higher allowance for loan losses and default risks once mortgage and loan repayment suspensions are discontinued. With a slow GDP growth rate, demand for capital will be affected, and with unemployment continuing to stay high, consumers will likely have less access to credit, which decreases banks' interest revenue.
All right, we're already running a little bit behind on time, so I'm going to keep this quick. In terms of the consumer staples sector, we have about an 11% weight right now, and we're looking to overweight this sector considerably. And the reason is, well, a couple of reasons. So the consumer staples sector has been historically known as kind of a defensive sector and recession-proof, just because people are going to buy essentials regardless of whether there is a recession or not. And this was the strongest performer, this sector, during the 2008 recession. But the big reason, though, is that so many companies in this sector have seen increased demand, especially food and household products. Um, and we have also recently been looking to include in our portfolio mature companies with higher dividend payouts. So that's why we are looking to this sector. And a lot of companies have adapted quite well to the pandemic. As you can see here, they have, like curbside pickup and other such options like online shopping have been expanded a lot. Companies have cut costs aggressively. And so we are looking at this sector favorably for that. We're also looking at the consumer discretionary sector quite favorably. We are looking to overweight this sector by some as well. This is because about 43%, almost half of this sector is e-commerce. And as you all know, e-commerce has done so well. You can see that year-on-year online sales have jumped considerably this year because of social distancing rules. So we will be looking at, there is the caveat that, a lot of travel, hotel, discretionary companies have in this sector have been very badly affected. But as demand picks up later this year, we are expecting to be able to invest in those companies at discounted prices. In terms of market timing, we think this will be a good buy, but this will be a few months in the future. And so we expect that spending will pick up again once the accumulated demand starts coming to the surface when social distancing guidelines are relaxed. So there are risks, of course, is that if unemployment continues to be high longer than we expect, then consumer confidence will be low and consumer spending will be low as well. And we will have to be very, very careful what stocks we pick, because several retailers have gone bankrupt since the start of the pandemic.
So for the healthcare sector, there are some fundamental drivers for this sector, including the aging population and the consistent underlying demand regardless of the economic conditions. But we also think there are multiple opportunities in this sector, and therefore we are going to overweight this sector, increasing the weight to 19.5%. So one of the opportunities is the demand for the telehealth, such as the remote monitoring, so that the patients can avoid waiting in the hospital. That will create a rapid and continued telehealth service market. There's some new trends of the demand is seen rising during the COVID-19 pandemic, such as cosmetic procedures, especially for the facial procedures. At the time of the pandemic, people can stay at home and don't go out. They can take care of their facial procedures. That's a new trend and could be an opportunity. Actually, although we see elective surgeries has a decline trend, the hospital ISM report for September actually found the elective procedure were at pre-COVID-19 level. And hospital PMI grows for 4 consecutive months. That suggests a better management of COVID-19 care in the hospital. However, we're still cautious about the second wave and the coming flu season. And so that will test the hospital's sustainability. Healthcare sector has some risks, such as the policy changes, especially after the election. We're not sure which parties and their policies could be quite different, like the Medicare for the cover from the federal government. Patient data privacy regulation and data security also could be challenged for the technology integration advances. Move on to the next page is material sector. Material sector is facing multiple headwinds. So we're going to end with this sector, decrease our holding weight to 1.5%. So firstly, material sector has been underperformed and relatively they are expensive. In the third quarter of 2020, we see 39% of the company in this sector, they missed the consensus earning estimates. That is the highest percentage among all the sectors, the 11 sectors in this index. So one reason is the demand for the manufactured goods is still weak. That leads a weak demand for manufacturing materials, especially like the steel. Paper mill is our holding security. So paper mill is also experienced decline demand due to the trend of the digitalization. Tension, of course, is increased the volatility. But at the same time, although the whole sector has underperformed, within this sector, the material sector, each industries could be quite different. Some industries actually shows promising opportunity, such as the construction materials, automotive materials, or some material essential for chip productions. So like we see the cement, concrete, they provide opportunity for this sector. So let's move on.
Okay, so I'm going to talk about the industrial sector. Our current weight is 10.15% and our target weight is 9.5%. Overall, industrial sector are more vulnerable to the supply chain shock. And during the earlier stage of the supply chain shock, we can see that that overall negative impact the industrial sector. And also we have the second wave possibility of second wave of the pandemic coming in Asia, so which will again negatively impact the industrial sectors. Another reason is China are more focused on the inner circulation because of the tension between the US and China. The inner circulation basically means that China will more focused on domestic consumer demand. So as the domestic consumer demand are increasing, the domestic consumer price will also be increasing. For industrial sector that supply goods in China, they will face a higher cost. And there are many uncertainties among the industrial sectors. The first uncertainties is the future defense budget, which will highly impact those large contractors. On the one hand, we have the high deficit level, which could result US to cutting the defense budget. On the other hand, the tension between the US-China would result the US continue to maintain a high defense budget. And also there are uncertainties in presidential elections with former Vice President Biden's plan on renewable energy. This will boost the infrastructure companies in the industrial sectors. Overall, due to the uncertainties and the foreseeable coming second wave of the pandemic, we are thinking lower our weight to 9.5%. Next page, please. Now I'm going to talk about the communication sector. Our current weight is 5%, and our target weight is 4%. The communication, 5G is a huge topic in the communication sector. It provides more speed, data, but on the other hand, all the telecommunication companies, Verizon, T-Mobile, AT&T are in a 5G race, which they need capital to build all those 5G infrastructure, which their capital are negatively impacted by the pandemic in current year. Also, they face another risk in my mind. Here is a pie chart shows the 5G total patents declared, filed, and are granted. In this pie chart, we can see that the two Chinese companies, Huawei and ZTE Corporation, are only 23% of the 5G patents. And those telecommunications companies need 5G gear to build their 5G infrastructure. However, without this 23% market, they need to find other company to buy the 5G gear, which means a less competitive market, which in the end causes a higher price, higher cost for the telecommunication company. And the broadband are growing due to staying home. People need access to the internet. However, on the other hand, due to the sport canceling, the event canceling, we are in a cord-cutting situation. Ravija, could you click once? Thank you. So in here, this chart showing that the US pay TV household will continue to decrease to the towards 2024, and which leads the consumer behavior change. Consumer are now more tends to focus on the streaming, which means streaming industry are booming. However, streaming industry is another competitive industry. We have over 300 platforms right now in the streaming industry, and also there are two main sources of revenue for the streaming industries. One is subscription, another one is ad. Businesses are reducing the marketing and ad spending right now and within a year. And for the subscription, customers has a limitation of the subscription. For example, me and you maybe can subscribe 6 streaming service, but 10 is a lot. So due to the high competitions in this industry, we are thinking lower our weight to 4%.
All right, and so we've just put together this little table to basically summarize what we said.
Okay, so next I'm going to talk about technical analysis. We use technical analysis as a guide for our asset allocation. So basically for the technical analysis, we look at the historical data to build back testing, to build asset allocation models based on the historical data. But in the end, we will adjust the weight based on our belief, based on the economic outlook analysis. So next page, please. So this chart are showing that we did a one simple year back testing to compare all the different asset allocation strategy to select the best one with higher return and lower risk. Next chart, please. Thank you. So we further back tested the asset allocation strategy for another 15 years by comparing with SP 500 index. The reason we choose SP 500 index rather than SP 500 fossil fuel free is because fossil fuel free is only created in 2016. So there's no significant data to back testing the fossil fuel free index. Overall, based on these results, we finalize our asset allocation strategy, but in the end, we use it as a guide. We will adjust the weight based on the economic outlook contributed by all the Redhawk fund members.
All right, thank you, Yichen. Sorry that last part was a little bit rushed because we're running a little late. Any questions from our audience? Please.
What are the best metrics to use when you analyze a company's stock? Like, what are the things you specifically look for to see, this isn't just speculation, this is a good value investment? Right,
great question. Chris, are you here? Since you just analyzed the company, do you want to share some of the things you looked at?
Yeah, sure, I am here. So first of all, we run through the financial analysis through the income statement and the balance sheet. And then we do a projection of the cash flow. We also look at the PE multiples or other multiples, market multiples that we see fit. And we also do a risk analysis of what kind of risk the company holds. And then we put those data all together and then we make a conclusion.
Thanks, Chris. So yeah, like Chris said, there's so many different things. We will look at the company's financials, past so many years, 10Ks and annual reports, income statements, and so on. But we'll also look at other factors outside of the company, the market, the industry, the competition. And there are different metrics like PE, like Chris said, EV, EBITDA. But does that answer your question a little bit?
Yes, it does. Thank you so much.
Thanks for the question.
So,
of course,
I noticed that you hold cash, and that in the summer you held quite a bit of it, about 25. Whether your portfolio would perform as well if you didn't hold cash?
Very interesting question. So given what happened with the market in March and the volatility after that, we are thinking that we would have fared much worse had we not had such a big cushion of cash. That said, though, like the overall market has recovered quite a bit since March. So, we are well diversified. So we don't think we would have had a very negative long-term impact, just that we would have been more impacted than we were. It wasn't a strategy. It just so happened that we had a large cash holding because we were making decisions at the time. Yeah.
Oh, so you entered the pandemic with a large cash holding?
Yeah, we entered the pandemic with a large cash holding.
I got you. Okay.
So, yeah. It was kind of lucky timing, I guess, just good timing.
Could be, yeah.
Yeah. Thank you, Dr. Walker.
Yes, I have a question. How much, because you guys touched on technical analysis, how much do you guys use that in reference to maintaining and watching, the stock movement? Is that something you check on every stock? Do you use technical analysis on every stock or every investment?
So, do you mean the kind of technical analysis and market timing and so on, or?
Yes, market timing, just overall stock movement,
Right.
just different technical support, resistance, things like that.
Yeah, thank you for your question. So we do not have a big focus on technical analysis. We are mostly concerned with fundamentals, which is why we invest in equities only, so that we can run those models and do an in-depth valuation. However, that does play some small role into our, so when we are ready with a valuation and a recommendation, we voted, okay, let's buy this, then we will look at the technical analysis just a little bit to kind of figure out what is the best time and what best price to buy, but mostly fundamentals, I would say. Yes. Does that answer your question?
Yes, thank you.
Thank you.
I have a question. With some of these extremely high growth stocks like Apple, for instance, do you guys ever set up a position where you have a limit where it'll sell if it experiences a tremendous amount of growth? Or do you plan on going long with these high risk stocks?
Excellent question. So we do not in our IPS have that limit yet, but so we have kind of a limit on, okay, initially buying, right? Like if we're buying a stock, we won't buy like more than a certain percentage of our portfolio. But if it grows a lot, and we've only recently in the last couple of years had this problem that, Apple and Microsoft became such large percentages of our portfolio. So we have discussed that, but so far we have not instituted a limit on, okay, if this goes up so much, we will reduce the position. We do have a downside limit contingency in our IPS. So for example, if a stock goes down more than 30%, then it has to be reevaluated. And then we will decide whether or not we want to get rid of this investment. But yeah, great question. We are trying to diversify away from it. So we'll just add other stocks in the IT sector, but then, sell some of Apple to buy that instead. Yeah, but we don't have a limit yet.
Okay, thank you.
Thank you. All right, time for one more question. Great questions. Please keep them coming. Yeah. Anyone?
How often do you rebalance the portfolio?
Hi, Karen. Thanks for your question. So we do a complete rebalancing every year, the asset allocation full process. But then every quarter, especially now that things are changing so quickly, we will do tactical asset allocation, which does not involve going through that long entire process. But that will mostly be somebody makes a suggestion, and then we'll vote on it if we think market timing is good for a particular sector. So once a year, but also every quarter. All right. Great questions. Thank you, everyone. We are going to transition into our trivia game now to give us a little break from all that information. So please take a moment to go onto this website, kahoot.it, and please register with your first name or whatever you're using on Zoom so that we can recognize you. And these are the three prizes. I am going to pull up my Kahoot now so you know what code to register with. All right, give me just a second. Go play host. All right, so can you all see my screen?
Yes.
Okay, great. So there is the game pin. Oh, music just started very loudly. Okay, there's the pin. If you enter, oh, okay, that's great. Whoever it is, please, if you could put an identifying name on there, that would be great. Thank you very much. We'll just take a moment to get our players in. And so this is going to be 15 questions. Some of them will be about the fund, so I hope you paid attention during our presentation. And then some of them will just be about finance in general. Some of them are specifically related to COVID-19 pandemic and the economy. All right, anyone still waiting to register, or shall we begin? Okay, let's wait like a few more seconds.
Oh, I'm sorry. I'm driving, so it's okay for you to begin. Sorry
Okay,
about that.
thank you.
Yeah.
Anybody else? Okay, we have 26. Going once, going twice. Oops. Gonna start right there. Okay, this is my first time, but let's see. So when was the Redhawk Fund started and with how much capital? Ten more seconds. Great. All right, this shows the answers too. Wonderful. All right. Next question. Which of these equities is our biggest holding as of last week by the percentage of total portfolio? There's Microsoft, there's Nike, Apple, and Amazon. We have 26 players, right, I think. Cool. A few more seconds. All right, so the right answer is Apple. Next one, how many stocks do we currently hold in our portfolio? This is as of last week, but that's unchanged to this week. 22, is it 32, is it 27, or 28? Few more seconds. 24 answers. Okay, the right answer was 28. We got some people. Which of the following is our benchmark index? The S&P 500 Fossil Fuel Free Index, the S&P 500 Index, the NASDAQ Composite, or the Dow Jones Industrial Average? Easy answer. Wonderful. All right. Next one. We got some people with a streak. Great. Which of these sectors does the Redhawk Fund not invest in? Is it industrials, materials, healthcare, or utilities? Almost all of our answers are in. All right, so we did not invest in utilities. Next one is, what is the current unemployment rate as per the latest jobs report, which came out on October 2nd, and this is published by the Bureau of Labor Statistics. Is it 7.9%, 14.7%, 8.4%, or 10.2%? All right. Next, we've got which of these companies developed remdesivir, the antiviral medication that is being tested as a treatment for COVID with varied success? Moderna, Biogen, Amgen, or Gilead Sciences? Lots of mentions in the news recently. All right, almost there. Answer was Gilead Sciences. Next one, we've got who is the current chair of the Federal Reserve, or the full title, which is the chair of the Board of Governors of the Federal Reserve System. Is it Alan Greenspan, Joe Biden, Ben Bernanke, or Jerome Powell? Easy one, got lots of answers already. All right. Okay, so Jerome Powell is indeed the right answer. Okay, so the CAPM is a model that describes the relationship between the expected return and the risk of investing in an asset or a security. What does the P stand for in CAPM? Is it portfolio? Is it purchase, pricing, or purpose? All the finance folks probably know this, or they should. All right, almost everyone in, and it is the capital asset pricing model. All right, this term is used to describe an extremely rare occurrence which has severe consequences and which is impossible to predict. What are we talking about? Are we talking about a black swan event, a butterfly effect, a zombie event, or the domino effect? Term was first coined by Nassim Taleb, I believe. All right, and we were talking about a black swan event, and one of the attributes of this is that in hindsight, people say, oh, this was so obvious. All right. Next one, the DJIA, or the Dow Jones average, it first appeared in 1896 with how many companies was this index first composed of? Was it 8, 12, 25, or 40? So today this index is composed of 30 companies, but it started with 12. All right. Our next one is about the world's largest stock exchange by market cap as of last year end. Which one is it? Is it the Japan Exchange, the NASDAQ, the London Stock Exchange, or the New York Stock Exchange? Right. Almost there, last couple of questions. Okay, that's right, it's New York Stock Exchange. Okay, so what does the SEC stand for? And this is, we're specifically talking about finance, investments, accounting. There's also something called the Southeastern Conference, but we're not talking about that. So which of these is the SEC? Is it the Stocks and Equities Company, Securities and Exchange Commission, Security Economics Conglomerate, or the Selection EDF Committee? There you go. It's the Securities and Exchange Commission. Great job. Next one. In which year was the S&P 500 index founded as we know it today? So Standard & Poor's merged and renamed as S&P 500 index. What year was that? And it was 1957. All right, last question of the quiz there. Who was the Fed chair during the financial crisis of 2007 and 8? Was it Ben Bernanke, Alan Greenspan, Janet Yellen, or Paul Krugman? Right. So I'm going to close this just after this question and announce the winners at the end. 3, 2, 1, and go. All right. Thank you all for participating. We are ready to now move on to the third part of our evening, which is going to be Chris and Keisha presenting on a financial sector equity. Whenever
Thank you, Ravija. It is so nice to see all of you, and I see a lot of familiar faces. I'm really thrilled. I'll share my screen.
Chris, can you and Keisha introduce yourselves just a little bit before you begin?
Oh, yeah. Can you guys see the screen?
We can see the Kahoot.
Oh. 1 second. Great. Now can you guys see it?
We can.
Yes.
Great, cool. So, hey guys, my name is Chris and I'm a MSF student. This is my third quarter here and I'm also a CFA level 2 candidate.
Hi guys, I'm Keisha. I'm currently a senior in the undergraduate program. I'm double majoring in finance and business analytics, and this is also my first year joining the Redhawk Fund family. So I'm excited to present with Chris.
So, as Ravija said, we are presenting in the financial sectors. The valuation that we have done is for Berkshire Hathaway, Class B. The table of contents, as you could see, we will start with company overview, and we will go with industry analysis, valuation, financial analysis, talk about the investment risk, and we will give you the conclusion. So we recommend a buy.
To interrupt, Chris. We only see the Google Chrome presentation. I think.
Yeah, have you started the present? Click on present, I guess.
May have shared Chrome instead of the presentation window.
Okay. Can you guys see it now?
Yep, we're good.
Okay, cool. Right, so I'll pick it up where we left. We issue a buy recommendation for Berkshire Hathaway. Our target price is $246.05, along with 16.11% upside from the current price of $211.91. Keisha will kick us off with the company overview.
Yeah, so like Chris said, Berkshire Hathaway is a diversified holding company whose subsidiary engages primarily in insurance, but there are also segments of freight rail transportation, energy generation and distribution, manufacturing and retailing, and they just hold a large portfolio of equity securities and derivatives which are reported separately from these main businesses. But how they first started actually was in 1965. Warren Buffett, as you guys may know, is a billionaire. He is the 7th wealthiest person on the planet. He actually bought it and formed a Berkshire partnership. 2 years later, he actually turned that conglomerate by using textile proceeds and bought an insurance, National Indemnity and Berkshire Hathaway Textile. And then he soon liquidated this and left Berkshire Hathaway and only had Berkshire Hathaway and diversified retailing. Soon after, he acquired multiple insurance companies. One big one that you guys may know is Geico, Central State Indemnities, and Genred. And as you can see, there's several acquisitions that he further acquired, more than 60 plus ongoing companies. Here you can see this Dairy Queen, American Express, Wells Fargo, Fruit of the Loom. Those are just a few of the examples on acquisitions that he's accomplished along the way. Following in January of 2010, he did a 50-to-1 split for the Berkshire Class B, which allows us to be able to afford these stocks instead of the really expensive stock for the Class A. And then we acquired the Burlington Northern Santa Fe Corporation, which is part of the railroad segment. And as of August 2020, the Berkshire Class B stock is the 7th largest component of the S&P 500, which accumulates about 40.5% of the common stock holdings, which is the largest stockholder for Berkshire currently. Here is a graph showcasing in comparison to the S&P 500. It's an index, as we've previously mentioned, to compare how the company is doing. And before the coronavirus, we can see that Berkshire Hathaway was outperforming the index. But once, as you can see, the green line over past December showcases when coronavirus impacted and had a lot of volatility in the market. It dropped and went into recession, and since then it's been gradually increasing, but the S&P 500 has still been outperforming. And this deals primarily with Buffett's conservative buy and hold method, which he really truly believes that you buy in certain companies based on their value and you wait until longer. There's going to be a longer return over maybe 10 or 20 years instead of a short-term gain. And not only to mention too, the IT sector has been doing an insane job of being very volatile in the financial market, and that is why the S&P 500 has slightly increased a lot more in comparison to Berkshire Hathaway. I will now give it to Chris to do the business overview.
All right, thank you. In terms of revenue segments, Berkshire Hathaway is extremely heavily diversified, maybe too diversified in terms of business strategy point perspective. Some of the segments have little to no synergy. Analysts might have a hard time figuring out what manufacturing, insurance, railroad, and energy will have synergy with. Along with that, insurance is the key player for Berkshire Hathaway. Approximately 25% of the pre-tax income comes from insurance, and it is one of the few sectors that have global presence. It also generates low-cost floats, which in Warren Buffett's letter to the stockholders of Berkshire, he mentions the importance of floats and how Berkshire Hathaway utilizes the floats in their business model. For those of you who are not familiar with the term float, it is basically the money paid to Berkshire Hathaway's insurance subsidiaries in premium that Berkshire Hathaway has not paid yet for the customers as claimed. Berkshire uses these floats to purchase financially damaged companies and fix them into good shapes. One good example was Fruit of the Loom. We will delve directly into the industry analysis and the competitive positioning. So one of the main industry that Berkshire Hathaway is in is the property and casualty insurance industry, also known as P&C insurance industry. The compound annual growth rate, also known as CAGR, for net premiums written by P&C insurance from 2004 to 2019 has been increasing 2.08%, where the value of premiums written by Berkshire Hathaway has been growing 9.36% from 2011 to 2019. Berkshire Hathaway is number 2 of the leading P&C insurance writers in the United States and is number 1 in terms of global. Among the global insurance written, United States account for 89%. We can see that the P&C insurance industry is extremely cyclical though, however. The net income after tax of P&C insurance industry falls significantly twice, and that 2 spots that you can see, the first one being the dot-com bubble of 01-02, and the second one being the subprime mortgage crisis, also known as the financial crisis of 08. With that being said, we are expecting the revenue to decline slightly on fiscal year 2020 and 21. However, we are expecting a bigger drop in the operating income to decrease in 2020 and 21. We are, however, expecting it to normalize by the end of 22.
So we also looked into railroad, energies, and utilities because they're a pretty well-defined segment for Berkshire Hathaway. Specifically, railroad is 7% and 6% for the energy and utilities, like Chris mentioned earlier. As you can see on the left side, it's about the last 4 years, they have had a steady increase, about 2% growth change. And then on the right side, you can see that the BNSF has been a leading competitor in the North American railroads by their operating revenue. There are the other highly competitors, as you can see. But particularly also in the energy, yeah, go ahead, Chris. And the energy, Berkshire Hathaway Energy, it's has been gradually increasing as well. On the left side is Statistica's graph on their operating revenue. On the right side, we have done a revenue and operating income forecast, a slight increase for the estimation on 2020, and then a gradual decline past the 2022, as well as for the operating income is a steady decrease.
So with that being said, Berkshire Hathaway faces a lot of threats from the competitors. The threats that we identify are very high competition on main business lines such as insurance and railroad. Also, in those particular business lines, there are extremely low brand loyalty, which makes Berkshire strive to earn customers by having lower cost. However, there are positives about competitions of Berkshire. One of the most important one is the entrance to insurance requires high costs, and most of the supplies that Berkshire Hathaway gets are standardized, and that means there will be lower costs to switch suppliers. We will talk about valuation. We have performed 2 types of valuation. The first one is intrinsic valuation. The method that we chose was discounted cash flow, especially free cash flow to the firm. And then the second one was relative valuation. We have chose price to earnings multiple and price to book multiple. We have given 70% weight on the DCF and 30% weight on the relative, and we have came up with the target value of $246.05. Intrinsic valuation for DCF, we have done a split income statement. We split the income statement into 2, the first one being the insurance and the others, the second one being railroad, energy, and utilities. The reason that we split the income statement is for a more realistic forecast, as impact of COVID-19 and the growth rates for the 2 segments we believe will differ significantly. We also have projected the revenue based on the total assets instead of projecting the revenue directly. The reason why we did this was there was inconsistent year-over-year revenue growth, and insurance companies hold a lot of assets on their hand, and therefore forecasting the asset level appears to be a more appropriate approach. We can see that the free cash flow will surge a little bit on 2020 and 21, and then will maximize in 22, and then we'll experience a decline after. Here is our WACC calculation and the actual calculation of our target price.
So the other method we used was relative valuation model, which is a business valuation method that compares the Berkshire's value to that of the competitors and industry peers and assess the financial worth. And we did it both primarily for railroad and insurance. And over here, you can see that railroad competitors' performance, there's only about 4 other leading competitors, a very fairly small segment. It's kind of niche. We used the forward PE ratio and the price to books ratio. The reason why we use the price to books ratio, also known as the price to book value ratio, it uses the asset and liabilities of Berkshire that are constantly valued at the market value, but it's from our findings on using different types of methods and different types of ratios, we found it to be more stable than the EPS or PS or EV to EV EBITDA, and it was a lot easier to predict because Berkshire has cash and cash equivalents on their hands, and since they primarily have insurance companies to pay off their claims or premiums, we decided to use the PE ratio. And from this weight, we did a 90% weight on the forward PE ratio and the 10% weight on the price to books ratio. Here you can see that the railroad competitors' performance was about weighted price was $329.68. Moving on to the insurance competitors' performance, there are quite a few. as we know, because it's primarily their segment. We did the same method. We did the forward PE ratio and the PB, and we did the same weights as well. And we had a estimated price of $221.10. After we found these two, we did a combination of both for the RV. And we did an 80% on insurance and 20% on railroad, primarily because the net income was paralleled to this exact ratio. And we had a final price of $243.61.
Right, now we will move on to the financial analysis part. Historically, Berkshire Hathaway has been maintaining a relatively low debt to asset ratio. As you can see on the chart on the left, it has never gone up to 0.6. The debt to equity ratio has been declining, which we can assume that the equity level has been increasing. On the right side, you can see the profitability ratio, which has also been increasing with the exception of fiscal year 2018. Now, Berkshire Hathaway has a AA credit rating by S&P Global, whereas most of the competitors are in the range of BBB to single A. They also hold more cash on hand versus the competitors, which better prepare them for the COVID-19. On the chart below, we can see the premiums written versus premiums earned in 2020 compared to 2019. We can observe that the premiums earned have actually increased. That is because of the unusually high earnings from Geico and lower than usual claim frequencies. Also, it is worth mentioning Geico Give Back Program, which is a 15% credit for 6 months policyholders, have not yet been accounted for. And when that gets accounted, the premiums earned will go down.
So for investment risk for Berkshire, they are currently undergoing, not currently, but they are challenged by stricter regulations, primarily in insurance, because they never wrote any pandemic insurance because they quoted there's no right price. The NAIC has been trying to process the state legislative proposal by forcing a lot of business interruptions in the insurance policy to respond to the COVID-19. The legislation has not passed, but it's still being challenged, and this may cause Berkshire to have a lot of lawsuit claims, litigation costs. However, even if the litigations do pass, this requires insurers to cover shutdown-related losses as part of the interruption businesses. But Berkshire's risk, due to the low numbers of such policies, it doesn't seem to be a big deal because the litigations would pass out in years instead of doing a massive upfront payout. In terms of volatility and cyclicality, the net income for insurance and railroad, as we have valued, has a small spike in increased growth, but a steady gradual decline. But this can also be affected by the depth levels that have increased in the number of Buffett stocks in recent years. For example, in middle of April, they sold the entirety of the U.S. airline industry, as many of us know, United, American, Southwest, and Delta Airlines, worth north about $4 billion. And Berkshire actually invested about $7 to $8 billion. So as you can see, the debt levels are rising. In terms of inflation rate and interest rate, we can't be sure because of the economy, depending on the election as well coming up. There's a possible cause deflation through the economy that price insurance could go up, and that trend could lead up to higher prices. But also negative interest rates would be an extremely high consequences for the financial market. In terms of the vaccine, it's unforeseeable future when there's the equity market may underperform slightly, especially at the general election. If the number of cases go down, then consumer sentiment, economy recovery, and job growth would follow. But going forward, we know there's going to be some short-term volatility. For certain, though, sorry guys, I can't speak, but right now there's no current civil unrest. Shutdowns have been caused financial headaches. There's only an increased payout on commercial property and casualty policies in current quarter. In short term, Buffett's conservative approach to investing his cash is more likely to have underperformance in corona-related insurance losses, but in long-term investment, the company still does look solid after its share price declines this year. So I will send it to Chris to conclude us.
Great, thank you. So in conclusion, we issue a potential buy recommendation for Berkshire Hathaway Class B. However, our decision is not final as we would need to see the updated earnings report for the third quarter of fiscal year 2020 that accounts for further adjustments. Now we will take any questions from the audience.
Thank you, Chris and Keisha. I just want to, before you all ask your questions, just want to say what a great job you did. And just to tell everyone, Chris and Keisha, this was both of their first presentations and valuations as part of the Redhawk Fund. So yeah, we're very, very proud of them. All right, open to questions now.
So I had a quick question. I had a quick question. So I thought it was a great presentation. I think you guys did well. But just one thing. So Apple in the Redhawk Fund is already a big portion of the portfolio.
Mhm.
And in Berkshire Hathaway, I think almost 50% of, they own, I think 100 billion, I have it pulled up right here, $100 billion worth of Apple, which is almost half of their whole portfolio of equities. So I thought, maybe are you guys not concerned about, your portfolio? You already own like 9%, and then whatever else you tack on to buying Berkshire Hathaway, you'd also have, that's also heavily weighted towards Apple too.
Right. To answer your question, the reason why we were doing this valuation was to reevaluate our holdings on Berkshire Hathaway. That includes what you just have told us, that Berkshire Hathaway has investments in Apple. We are also looking at getting rid of some of our holdings on IT, which could be Apple. So yeah, if that answered your question, the reason why we were doing this was to reevaluate our investment in Berkshire Hathaway.
Great, thank you.
Yeah, that's a very valid concern. We are definitely concerned about concentration risk. And we actually set out, if you remember from the sector analysis, we're actually trying to lower our financial sector, I guess, allocation. But, it just so turned out that this turned out to be a buy recommendation. So
right.
we told this, we were trying to actually sell it, but it turned out to be a buy recommendation. However, this is just the initial recommendation. First, like they said, they're going to take into account the next quarter's or this quarter's earnings when they come out. Then we're going to go through an extensive review process. So how it works in our fund is an analyst or a team of analysts will pick a stock and then evaluate it, present it to the whole team. Then like you are giving input, our entire team will give their input and feedback and ask their questions. And then it goes to the managers who do an extensive review of the actual valuation, like the Excel sheet, to see if everything looks good and if there are any questionable assumptions. Then it goes to Kathy, who is our faculty advisor. Then she looks at it and gives her feedback to make revisions. And then we put it to the vote. So oftentimes it happens that by the time it goes through the revisions, the recommendation is going to change to become a not buy or a sell or a hold even. So so this is why we have these discussions, so that we can like you said, the Apple concern, we can bring up concerns that our analysts might not have thought of, right? Yeah. Thanks, Thomas.
I have a question. So what is the reason that we don't hold energy in our portfolio?
Because when we went, so that was 2 years ago, about that the Seattle University Board of Trustees went fossil fuel free, and since the energy sector is heavily inclined, I guess, towards heavily weighted towards lots of fossil fuel companies, I guess there are renewable energy companies as well. So we at that time they decided to entirely divest away from that for our portfolio.
I know this company is under financials, but they hold energy and utilities under their revenue segment.
That's right.
Is it appropriate for our portfolio then?
Great question. Yeah, so that's one of the reasons we're looking at this company now, actually. So when the announcement was made, or when the decision was made in 2018 by the trustees for the endowment, it was decided by the year end 2020, we would divest away about 50% of all fossil fuel related assets, I guess, in the endowment. And by 2023 is the deadline to get rid of everything. So this is more about, so this is permissible right now. According to our IPS, we would not buy anything more that is energy or utilities. But since we've been holding this since, what was it, Chris? 2014, 13?
Yeah.
Yeah. So we've been holding this since 2013. We still have a couple years. Now it's about when is the right time in the next 3 years to divest away from this company.
Okay, thank you for the clarification.
Oh, I think, Alvaro, did you have a question? I just saw your raised hand.
Yeah. How often do buy recommendations come through to portfolio managers? And how long does it take to how long does the purchase process take after the decision to buy has already been made?
Oh gosh, what an excellent question. Elias, do you want to say something about this?
Yeah, sure. So typically, so in terms of how often buy recommendations happen, uh, I'm not entirely sure, but basically it really depends on the company that's being chosen and our goal. Um, if we're trying to decrease the allocation, we'll try and look at a company that we're holding that we think is overvalued. If we're trying to find a new addition to raise our weight, then we'll try and find one that's undervalued. And typically those will correspond with the buy and sell. In terms of the process, that's something that we've all been working on to cut down. But typically what will happen is we'll have as Ravija mentioned, we'll have our presentations like this one that Chris and Keisha did. And then we will do an in-depth review. So I was their portfolio manager for this presentation. So I'll go through the Excel sheet, look at their valuations, see if anything stands out, and we'll review it as a team as portfolio managers. And then we'll send the summary and talk to Kathy about it. And then if there's any action that needs to be made, we as a team, Redhawk Fund, will vote on it, and then we submit the trade. But it's a lot of back and forth between making sure we get everything and talking to Kathy, see what her inputs are, making those adjustments, and throughout the whole process, the valuation can change dramatically.
Yeah, and I think, Alvaro, you were getting at, like, is this really efficient to do so much review, right? It is not really. In the real world, it does not take this much time. Sometimes we'll go weeks or even months between the actual proposing an investment to, putting in the trade. But since the primary goal of our fund is learning, right? Like learning to do these fundamental analyses and valuations and learning how to perform and operate in a professional environment, we focus more on that aspect. But yes, it does take a long time, and we've had, from our analysts, we've had many comments like this. Oh, by the time we got around to buying, the upside was lost, so we can't buy this anymore. So we are trying to work a little bit on improving our timeline and efficiency. But yeah, just the very nature of the work we do, since we're a student-run organization, there are definitely inefficiencies in the process, which we're okay with because our focus is on learning and not, making them. We do want to make returns, but that's not our main goal. Yeah.
Thank you so much for answering that question.
Thank you. Other questions about Chris and Keisha's presentation and valuation, or about the Redhawk Fund as a general, as a whole, or to any of our members? Alvaro, did you have another question? Please feel free to go ahead.
Yeah, if no one else thought, yeah. This one was one I was really interested in, but during the wake of the pandemic and everything going on, like I guess the saying, like the market can remain irrational longer than you can remain solvent, probably like plays in your head a lot more. What was kind of the perspective or kind of outlook that you had when the late March collapse happened, and how did you kind of decide this is the direction the market is going. Like, what actions should we take? Because I'm imagining that's a really stressful moment, but also a great opportunity to learn. So I just would love a lot of insight on that, because that to me is super interesting.
Yeah. So this was kind of a once in a very long time moment, right? Like, this doesn't happen every day. And it was super stressful. In a way, it was great because none of us had experienced this, and none of us knew what to do. Um, so we had several stocks in the pipeline at that time that we had even voted on. We were like, okay, let's buy this. And then we were just waiting to put in the trade, like literally the next day. And so first of all, we just kind of put a hiatus temporarily on trades. We're like, okay, we're not going to do any trades right now. We talked to Kathy, we went to talk to Jot, we talked to anybody we knew who was like a professional and an expert, who knew more than us, and we asked for advice. And everyone was like, this is what I think, but I can't be sure because the whole market, like, it's not like anybody had the answer. So yeah, the biggest thing we did was we put a temporary hiatus on trades because it seemed like it would fall further, the market, and so it would be like catching a falling knife, which we did not want to do. The other thing we did was usually we talked about doing the asset allocation, strategic asset allocation process once a year, but we did an emergency strategic asset allocation or an interim allocation where we all took one sector and then we reevaluated the future of that sector, how it had changed in the last few months since we thought, okay, this sector is going to go up, down, whatever. And then we redid our allocation. Then we started over with that. Yeah, those are some of the steps we took, but mostly it was like, running around, talking to people, being very stressed. But, we had a big cash cushion, so that definitely helped a lot with kind of protecting our investments.
Thank you for answering my question. I'm glad you had that
Yeah.
that large cash on hand.
Yeah, and it was just lucky, Great questions. Thanks so much. Are you a student at Seattle U?
I am, yeah. I'm applying for sure.
Okay, great.
It looks super interesting to me, so I was really interested.
Yeah, we would love to have you on board, and anybody else who'd like to apply. The application deadline is tomorrow. Just a reminder. Any other questions or comments, feedback? All right, if not, I'm gonna go and announce the results of our Kahoot trivia game. And congratulations. So these three people, Jacob, Oliver, and Arsh, won our top 3 prizes. And we would like for you to send me, I guess, or stick around a little bit after if you have time, your email address or some form of communication so I can get in touch with you to send you your prize. Right. Any comments or questions about the trivia game? This is the first time we're doing it. Was it fun? I don't know, engaging, I guess.
Yeah, it was fun.
Okay. Any comments
it was
on how we can
enjoyable.
change it? Something different you'd like? No. Okay, we will send you a survey right after, so maybe you can tell us there if you don't want to be mean right to our faces. Okay, great. All right, so thank you so much, everyone. And one last thing I want to share with you is how to contact us. We've loved having all of you here, talking to us, engaging with us, but we would love to also continue to talk to you all. We have a website on the Seattle U page. You can just Google it. We have a LinkedIn for the fund. We also have a YouTube channel and an email, a dedicated email that you can use to get in touch with the Redhawk Fund. And if you would like, you can just take a picture of this or scan this. This will take you to our website, which also has all the other links on there. Thank you so much for joining us, and we'll stick around